For over a century, General Electric wasn't just another company. It was America itself. If you looked around your home, your hospital, or even the airplane taking you on vacation, chances were GE had built part of it. Light bulbs, jet engines, MRI scanners, power plants, General Electric helped shape the modern world. It was once the most valuable company on earth. Investors trusted it. Governments admired it. Business schools taught it as the gold standard of corporate excellence. Then everything changed. Today, the company that survived 2 world wars, the Great Depression, and countless technological revolutions no longer exists in the form that made it famous. After more than 130 years, General Electric was broken apart into separate companies, ending one of the greatest business empires in history. So how did America's greatest industrial giant lose its crown? The answer isn't one bad CEO or one unfortunate recession. It's just the story of how chasing short-term profits slowly replaced long-term innovation, and how success itself became the company's biggest weakness. To understand GE's fall, we first have to understand why it became so powerful. The story begins in the late 19th century with one of history's most famous inventors, Thomas Edison. In 1892, several electric companies merged to create General Electric. Electricity was transforming cities, factories, and homes, and GE was at the center of that revolution. Over the following decades, GE became much more than an electrical company. It manufactured household appliances that millions of families relied on every day. It built turbines that powered entire cities. It became a leader in medical imaging, helping doctors diagnose diseases with groundbreaking technology. It designed jet engines that carried passengers safely across the globe. Few companies had such a broad impact on everyday life. By the second half of the 20th century, General Electric had become one of the largest corporations in the world. But its greatest rise was still ahead. In 1981, a new CEO took over. His name was Jack Welch. Few executives have ever been as influential or as controversial. Welch believed that every GE business should either be number 1 or number 2 in its industry. If it couldn't dominate, it would be sold. He aggressively streamlined the company, closed factories, sold weaker divisions, and cut tens of thousands of jobs. Supporters argued he made GE more efficient. Critics said he transformed the company into one obsessed with quarterly earnings. Regardless of opinion, Wall Street loved the results. During Welch's 20-year leadership, GE's market value exploded from roughly $14 billion to well over $400 billion. Investors viewed GE as unstoppable. Business schools praised Welch as the greatest CEO of his generation. Fortune magazine repeatedly named GE the world's most admired company. Everything seemed perfect. But beneath those impressive numbers, something important was changing. GE had always been known for engineering. Now finance was becoming its biggest source of profits. That business was called GE Capital. Originally, GE Capital existed for a simple reason. If customers wanted to buy expensive GE equipment, the company could help finance those purchases. It made selling industrial products easier. Over time, however, GE Capital expanded far beyond that original purpose. It began offering consumer loans, commercial real estate financing, credit cards, aircraft leasing, insurance, corporate lending. Before long, GE Capital wasn't just supporting the industrial business. It was becoming one of the largest financial institutions in America, and it was incredibly profitable. In some years, nearly half of General Electric's total profits came not from making products, but from financial services. To investors, this looked brilliant. Financial businesses often generated higher returns than factories. They required less manufacturing and produced impressive earnings growth. GE's stock price continued climbing, but there was a hidden danger. Financial profits are often easier to generate during good times, but they can disappear much faster during a crisis. Unlike industrial equipment that lasts decades, financial assets depend on confidence. If credit markets freeze, even the strongest-looking balance sheet can quickly become fragile. GE was becoming less like an industrial company and more like a giant bank. Most people didn't realize how significant that shift had become. Neither did many investors for years. The economy remained strong, masking the growing risks beneath the surface. Then came 2008. And suddenly, everything changed. In September 2008, the collapse of Lehman Brothers sent shockwaves through the global financial system. Banks stopped trusting one another. Credit markets froze almost overnight. For companies that relied on borrowing money every day, it was a nightmare, and General Electric was one of them. Although most people still thought of GE as an industrial giant, a huge portion of its profits and its financing came from GE Capital. When the financial system seized up, GE Capital suddenly faced enormous pressure. The company struggled to access short-term funding, one of the lifelines of its financial business. Investors began asking a question they had never seriously considered before. Was General Electric actually much riskier than anyone realized? The market answered quickly. GE's share price collapsed. Its once proud AAA credit rating held for more than 50 years was, for a company that had symbolized stability for generations. It was a devastating psychological blow. To strengthen confidence, legendary investor Warren Buffett invested billions of dollars in GE during the crisis. The U.S. government also introduced emergency programs that helped stabilize financial markets, giving companies like GE time to survive. General Electric avoided bankruptcy, but survival came at a cost. The company cut its dividend for the first time in decades. Management promised to reduce its dependence on financial services and return to its industrial roots. It sounded like the beginning of a comeback. Instead, more mistakes followed. In 2015, GE announced one of the biggest acquisitions in its history, the power business of Alstom. The deal was worth more than $10 billion. Management believed global demand for gas turbines would continue growing for years. But reality moved in the opposite direction. Renewable energy expanded faster than expected. Governments invested more heavily in wind and solar power. Demand for traditional gas power equipment weakened. GE had spent billions buying into an industry that was already slowing down. The acquisition soon became a massive burden. At the same time, the company's oil and gas investments struggled as energy markets became increasingly volatile. Several business divisions underperformed. Large write-downs followed. Debt continued piling up. Investors who had once believed GE could do no wrong were losing confidence. Leadership changed again. New CEOs arrived promising another turnaround. Assets were sold, costs were cut, thousands more jobs disappeared, but none of those moves could restore the company to its former glory. The problem wasn't just one bad acquisition, it wasn't only the financial crisis, and it wasn't simply poor timing. For years, GE had prioritized financial engineering over engineering itself. Instead of focusing on breakthrough innovation, management became increasingly focused on quarterly earnings, acquisitions, restructuring, and satisfying Wall Street. The company that once invented the future has slowly become a company trying to manage spreadsheets. Its competitive advantage faded little by little. Eventually, management accepted a reality that would have been unthinkable only a generation earlier. General Electric was simply too large and too complicated. In 2021, the company announced it would split itself into 3 independent businesses. The breakup marked the end of one of America's greatest corporate empires. Today, the aviation business continues as GE Aerospace. Its healthcare division became GE Healthcare. Its energy businesses now operate as GE Vernova. The General Electric name still exists, but the industrial giant that once dominated the global economy is gone. For more than a century, GE represented American innovation. It helped electrify cities. It built technologies that saved lives. It powered aircraft, hospitals, and industries around the world. Its legacy cannot be erased, but its story also serves as a warning. No company is too big to fail. No reputation lasts forever. When businesses become obsessed with financial performance at the expense of innovation, they may continue looking successful for years. But eventually, reality catches up. General Electric didn't lose its crown in a single year. It lost it one decision at a time. And that may be the most important business lesson of all.